Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. On the show today, we are going to talk everything about international funds and fund of funds. Now, we've been discussing about how this definition of specified mutual funds that has been changed in the budget, and that does give some relief to some of the categories, which includes international funds and fund of funds, where they will get back the indexation benefits. The long-term capital gains, they will be charged only after you keep a fund for a certain period of time. To understand how the impact could be, how this would make these categories very attractive for investors, and what it changes for the ones holding it right now as well. Let's welcome Nasser Salim, the managing partner at Flexi Capital, and Nirav Karkera, the head research at Fisdom. Gentlemen, good afternoon. Thank you so much for joining us. Nirav, let me start with you, because as I've pointed out, there have been changes in budget with respect to time for long-term capital gains in this budget, be it for international funds, be it for fund of funds. How does that change things for both the categories and the investors?
So Sonal, first off, always a pleasure chatting with you on interesting topics like this. So one very important development along with the tax slab change is the reduction of the holding period to qualify for long-term capital gains. I feel this was in the offing since quite some time now. The earlier threshold of 36 months for most assets were just too long, and 1 year being just too short. I feel the new threshold of 24 months is a very favorably sweet spot, and this will encourage investors to push towards holding out for much longer and to benefit from the longer term, more accretive taxation regime. So we can expect a behavioral shift, at least in preference, at least at an intent level, to try and breach the long-term threshold of 24 months. This also at a very fundamental level embeds a very strong undercurrent and a strong belief system for long-term investing. So this is, as a country, it's important that we also start valuing long-term investing. Now that short-term is all the fad, I feel this move is a much more welcome move also from a behavioral nudge standpoint.
Okay, all right, get that point. So, just from the international funds perspective, Nirav, how has the AUM movement been in the last couple of years?
See, the AUM has really skyrocketed over the past couple of years. So while the mutual fund industry in general has really grown at a very fast pace, international funds, the uptake has been quite robust. In fact, over the past 5 years, it has grown by almost 4x, right, which is pretty phenomenal. And as investors are getting more aware and more savvy about the opportunities that they want in their portfolio, they will continue to take exposure to international funds. So around 4x growth, and we see it growing sustainably even further ahead, of course, sans the regulatory caveats.
Okay, all right. As Nirav has been saying, in 2024, there are 63 international funds, the number of schemes with an assets under management number of 44,059 crore rupees. In 2020, there were 36 such schemes with assets under management of just 13,143 crore rupees. So there have been a massive movement there. Let's welcome in Nasser in the discussion as well. Nasser, first, your take on the changes that have been made, and is the industry asking for more limits, the raising of limits in international funds, because a lot of them have not been able to take in funds because of the restrictions that have been placed in?
Good afternoon, Sonal. Thank you very much for having us over. It's always a pleasure. No, I think completely agree. So 2-3 key points there, Sonal, to your question. Number one, I think one of the major things that will now get kind of more impacted is international ETFs, because now they qualify for long-term capital gain in 12 months. While, of course, FOF, fund of funds, will qualify for LTCG taxation after 24 months. So I think one is that very important change, which will attract a lot of money going in through the international routes, through international ETFs, stronger interest inflows in international ETFs as compared to fund of funds. That could be a possible change that we kind of envisage. The other quick one, Sonal, is obviously the reduction in holding period, as my colleague said it, is a welcome step for overseas. It will attract longer term, investing as well. Behavioral change will happen. And, also the switch from the slab rates to 12.5 may also induce more interest in these funds going forward. And of course, in the last 4 years, we've seen Forex jump, as you rightly mentioned. And because of these slab rates, it may influence investors to have longer holding periods, which is, again, a very important behavioral change, because patience always plays out very well in terms of investing. To your second quick point, I think, as far as the limits are concerned, currently, as per the RBI mandate, I must tell you, overseas investment limit for domestic mutual funds is restricted to $7 billion for the entire industry. Now, obviously, each asset management company can invest up to $1 billion in foreign securities. So that is a cap which is very, very important. And, investors, when they're looking at and when they're seeking guidance, obviously, that is something which is need of the hour, because a lot of times when that limit gets breached, Sonal, the asset management company stops inflows. Now, to your third point is that as far as limits are concerned, yes, I think it acts as a global hedge. Diversification is something which is very, very important. India, for example, currently is, we're at pretty, expensive valuations. We feel that there are certain pockets of opportunity, and therefore the industry demand is, why don't you diversify and give us more, enhancement in the limits, which is currently at $7 billion at the industry, and just for reiteration, $1 billion as far as asset management companies are concerned.
Okay, all right, gentlemen, we have to get into a quick break. On the other side, we'll continue our discussion with our guests to understand the overseas funds, international funds, and of course, fund of funds. Stay tuned. Welcome back. You're still tuned into MF Corner. We still have with us Nasser Salim and Nirav Karkera. We are discussing everything that could impact the changes that we have seen in international funds and fund of funds with the budget. Nirav, let me come to you. Now that we are talking about this change that has come by, and we are of the opinion that maybe, yes, this will be an attractive scheme for investors, are there enough opportunities available globally to invest more money?
Yeah, I feel there is a pretty solid case for global investing. In fact, the opportunity emanates from the listed universe that we have in India versus what we would like to tap into. I could talk about a few examples. For example, we could talk about companies engaging in space tech, engaging in development of electric vehicle components, probably semiconductors, and artificial intelligence on the generative front. And there are a host of several such sectors. Even luxury consumer goods. We all know that these are good, thriving sectors, and they have a pretty solid visibility in terms of having a runway towards growth. But there are very limited companies on the Indian bourses that actually let you capture all of these stories that are happening. I feel while the the straightforward thing is always there, diversifying away from country risk and taking exposure to a cross currency, while those are the standard staples that build the case for international investing, I feel the opportunities in the listed universe is a very key value proposition that most of us don't really appreciate that global funds bring to the table, right? So while India expands and the listed universe also grows to capture many new age companies like we have been seeing, there are also a lot of innovative companies, sectors, and segments, sunrise segments that are getting listed on the bourses abroad as well. Right from dating apps to renewable energy. And to generative AI, there are several plays that one can take exposure to and ride the tide if they have access to such global funds. So that's where the case for international investing solidifies even more.
Okay, all right. So there are a lot of places available where there can be an investment done. Nasser, what is your take on this one?
Absolutely, Sonal. I would agree more. I would not agree anymore. This is completely. The fact that, the very fact that you can diversify. And I think, interestingly, currently, there's a lot of opportunity available in markets, which will help you diversify. Whether it's the US in terms of US Treasury yield funds, or whether it's in China, we're looking at great valuation there in terms of its multiple, looking very attractive and it's cheap at the moment. So, it definitely gives you a great platform to diversify. I think, softer than expected inflation data and cooling economic indicator. For example, the Fed expects 1 to 8 cuts this year. lower treasury yields. These are all factors that you may want to diversify your portfolio into certain US instruments. Then there are, between that we have also artificial intelligence. I think those are something which is again being very well captured by some of the larger asset managers that we work with and that have been regulated. I think the other quick one, of course, is a global diversification from a return perspective always holds beautifully when you look at the overall portfolio. And to diversify from a currency risk perspective, normal hedging, global hedging, I think all of these factors play out really well. Some of these have actually captured it really well. And we feel that from a portfolio perspective, international diversification of these funds, whether it's in tech, because if, for example, in post 2020, we saw a surge in technology, which led the rally as well in the US. So I think it was very well captured, bodes really well and augurs really well from a portfolio diversification perspective. And I think yes, it is a big opportunity.
Okay, all right.
Subject to market, subject to one's risk appetite.
Oh, yes, of course. That has to be taken into consideration. Nirav, we've seen a lot of changes with a lot of these mutual funds coming out with releases saying that we'll not accept lump sum, we'll not accept SIPs. It's a long list. Which are the ones which are open for subscription? Some of the bigger ones that you can talk about where maybe lump sum is not allowed, but SIP or vice versa, or both are allowed or both are not allowed?
So that's indeed quite a long list, and inadvertently it happens so that most of the large AMCs have at least a couple of options where either the SIP or the lump sum route is open. I feel the list, my guesstimate is the list is around 45 odd funds where the funds are actually open for SIP as well as lump sum, but there will be a few cases like probably a Motilal as well where the SIP is still active, and at the same time there could be a few funds like the Franklin India feeder where a lump sum as well as an SIP is allowed. So there are various combinations, as you said, but the ones where both are active, it is almost a 45 fund long list. And one thing I can tell you that most larger fund houses and fund houses having a very strong suite of international funds and FoFs will have at least a few options for retail investors to nibble into. So it's not as if the gates are completely shut. So, with a little bit of hard work, investors can still find some very good opportunities managed by some very good funds.
Okay, take that point. So 45 of them have both the routes open, be it lump sum or SIPs, but some of the other ones have a combination which works for them. Sometimes it doesn't, but take your point there. Nasser, I wanted to understand, are direct investments in US or international stocks more cumbersome, and that's why maybe people go for mutual funds?
Yeah, Sonal, great question again. I think, the investments as far as direct investments in US stocks or international stocks are concerned is obviously could be a little cumbersome, but the investments are subject to double taxation and have been impacted negatively by the 20% TCS, which has been introduced, as we all aware of. However, the 20% TCS combined with the recent budgetary changes, now that have been announced on the 23rd of July, Sonal, we feel that may create a conducive environment for stronger inflows in the international and US Treasury fund. So, definitely, erstwhile, before 23rd July, they were subject to double taxation and they were, majorly impacted because of 20% TCS. But now with this budgetary change, things may start moving around and may start attracting more flows.
Okay. Nirav, your take here?
So I feel it is indeed cumbersome. While the industry is still continuing to demand an expansion of the LRS limits, I feel this is not a ubiquitous problem. This is not the biggest problem that we are facing. What we're facing is getting access at the lowest level possible, and that access is largely restricted due to the operational hassles. So this is a classic case where something is available but not really accessible. There's a thin line differentiating between the two. So the entire rigmarole of going through the additional KYC, the additional disclosures, and going through the route, LRS route, and opening an account there and taking exposure is really cumbersome, and for especially smaller ticket investors, right, the retail mass, and also good part of the mass affluent segment. The effort to reward just doesn't make a whole lot of sense. I mean, there is a strong value proposition for investing overseas, but the cost and effort benefits must also match or balance or be in tandem with the value proposition out there. So that this entire cumbersome process is quite a deterrent for direct investing, and especially it is a whole lot more pronounced, especially when you have options like mutual funds, where life is not just far more simpler operationally, but also from a cost standpoint is a whole lot more efficient, and from a return standpoint so much more effective. So like you said, I feel that is indeed the case, where the options of mutual funds makes life so much more simpler, that no one's really feeling the pain or recognizing the pain that it would be to take exposure to other stocks otherwise.
Okay, absolutely. Take your point. It's something that you can just invest in and not worry so much about the compliances so much, right? Gentlemen, it's a great conversation, but we have to get into another break. On the other side, we'll continue our discussion with our guests on overseas funds and fund of funds. Stay tuned. Welcome back. You're still tuned into MF Corner. We still have with us Nasser Salim and Nirav Karkera. We are discussing everything about international funds and fund of funds. Nirav, we have discussed it a couple of times, but has that 20% TCS made people a little averse to investments there in general? Is that something that is keeping them away from international investing?
I'd not say that, I'd say that's not the most, that's the most pressing issue at hand right now, but it is a deterrent nonetheless. And the roots lie in something as basic as IRR. So if your initial cost, increases, by a certain extent, in this case by 20%, because that is the TCS, and I'm calling it a cost because that is an amount that is not deployed, your IRR drops significantly, right? So to make the same amount of money, you will have to, or the same amount of returns, dollar returns, you will have to invest a whole lot more money, right? So this is, this entire 20% TCS really expands your initial outlay and shrinks your IRR to a significant degree, which also reduces the sheen of the proposition to a great extent, especially for investors who are trying to invest for the relative medium term. A 20% initial outlay and the resultant drop in IRRs make it a little lackluster proposition. Still, investors who would like to invest for a much more longer term and strategically, for let's say, for the sake of example, 10 years and onwards, it could still make some sense. But anyone below that will be slightly conscious because of this entire IRR dilution impact that this 20% TCS is having.
Okay, all right. Nasser, how do you look at the new category that has come by, US Treasury yield fund of funds? We do not have a lot of fund options available here for investing, but is this a great way to take exposure in the US bond markets?
Absolutely, Sonal. I think, the Treasury securities of longer maturities give the benefit of roll down yield. And I think that is being very well captured by some of them. Currently, I think we have about 4 of such longer maturities available through investments in fund of funds. They're in the nature of Bandhan, DSP, Access, Aditya. There are 4 of them broadly, and most of them invest in 7 to 10 year Treasury bonds invested. However, may even have shorter term maturity securities depending on their outlook on the interest rates. The other quick one is, I think, as federal rates are expected to get cut, yields for off-run older securities increase if the security gives a high rate of interest compared to their one on the current counterparts, and therefore are more valuable in nature. I think the rate cuts being around the corner may impact the US Treasury fund of fund entire segment, Sonal, positively, especially for the longer term maturity funds. And what we feel is also currently, if you see historical average of Fed rates has been, historical long-term average is about 1.86. Current Fed rate is about 5.33 as we speak. So there is a lot of the gap needs to shorten, and that is going to help get capital gains on those bonds. And I think the other quick one is that with these category, as you mentioned clearly, they have multiple maturities available. So they have short term, which is 3 months to 1 year. You have medium term, which is up to 3 to 5 years in terms of maturities. Long term is between 7 to 10 years. So it's a very good, interesting category that is emerging with all asset managers. And I think, does bode well with the current economic environment that we are in as far as the US is concerned.
Okay, all right. Gentlemen, thank you so much for joining us today. It was such an interesting discussion because there have been a lot of budget changes which has impacted these two categories. With that, we'll do one thing. We'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.